In 2026, a powerful question is circulating across the United States. Are home prices finally falling, and is the long-predicted housing market crash actually happening? For years, Americans have watched property values climb to historic highs. Cities that were once considered affordable saw dramatic increases in home prices, pushing ownership further out of reach for millions of families. Now, signs of cooling in certain regions have sparked debate among economists. Real estate agents, investors, and everyday buyers to understand what is happening in 2026. It is important to look at how the housing market reached this point. During the early 2020s, historically low interest rates encouraged borrowing. Millions of Americans rushed to buy homes, refinance mortgage, or invest in property. Demand surged while supply remained limited. Builders struggled with material shortages, labor constraints, and rising construction costs. As a result, home prices climbed rapidly across most states. By the mid-2020s. However, interest rates began to rise as policymakers attempted to control inflation. Higher mortgage rates significantly changed affordability. A buyer who could afford a large loan at 3% interest suddenly faced payments hundreds of dollars higher at 7% or more. This shift reduced purchasing power and cooled demand in many areas. Sellers who once received multiple offers above asking price began experiencing longer listing times. In 2026, the market shows a mixed picture rather than a single, nationwide crash. In some overheated metropolitan areas, especially those that saw extreme price growth during the boom years, values have stabilized or slightly declined. Cities with high living costs and heavy reliance on specific industries have felt more pressure. Remote work trends also reshaped demand. Some buyers moved away from expensive urban centers to suburban or smaller regional markets, spreading price increases across new locations. Inventory levels remain a key factor. While demand has softened in certain areas, supply is still limited in many parts of the country. Homeowners who locked in very low mortgage rates during previous years are reluctant to sell. If they move, they would need to finance a new home at much higher rates. This phenomenon, sometimes called rate lock effect, keeps existing homes off the market and prevents a dramatic surge in supply. New construction has increased compared to peak shortage years, but builders remain cautious. Rising material costs, land prices, and financing expenses affect development decisions. Developers are focusing more on smaller homes and build-to-rent communities rather than large luxury properties. This adjustment reflects changing consumer preferences and affordability constraints. Another major factor shaping the 2026 housing conversation is rental market pressure. In many cities, high home prices pushed potential buyers into the rental market, driving rents upward. However, as new apartment complexes were completed and demand stabilized, some rental markets experienced slower growth or slight declines. Rent trends often signal future shifts in home buying patterns because renters represent the next wave of potential buyers. Financial institutions are also playing a critical role. Lending standards in 2026 are generally stricter than they were before the 2008 financial crisis. Most borrowers must meet clear income verification and credit requirements. Adjustable rate mortgages exist, but are not as dominant as in past housing bubbles. This stronger underwriting environment reduces the likelihood of widespread foreclosures caused by risky loans. As a result, even if prices decline in some regions, a severe nationwide collapse similar to 2008 appears less likely. However, affordability remains a central concern. First-time homebuyers face significant challenges. High down payment requirements combined with elevated mortgage rates make entry difficult. Student loan obligations and rising living costs further strain household budgets. Many young professionals delay homeownership or rely on family assistance for initial payments. Investors are closely watching the market. During the boom years, institutional investors purchased large numbers of single-family homes, especially in fast-growing states. In 2026, some investors are slowing acquisitions due to higher financing costs and lower expected returns. If investor demand decreases substantially in certain areas, local prices may adjust downward. Regional differences are especially important.
States with strong job growth, diversified economies, and steady
population increases often maintain relatively stable housing demand. Areas heavily dependent on one industry may experience sharper price swings if that sector faces layoffs or contraction. Migration patterns between states also influence local markets. Tax policies, climate conditions, and quality of life
factors shape where people choose to live. Economic conditions overall continue to influence housing.
Employment levels, wage growth, and consumer confidence all impact buying decisions. If the broader economy remains stable with moderate growth, housing corrections may remain controlled. If a recession emerges with significant job losses, housing demand could weaken further. Technology has transformed how buyers and sellers interact. Online listing platforms, virtual tours, and data analytics tools allow consumers to compare prices instantly. Greater transparency means overpriced listings are quickly identified. Sellers must price competitively from the beginning rather than relying on aggressive bidding wars. Another trend shaping 2026 is the rise of alternative housing models. Co-living spaces, modular homes, and smaller footprint designs attract buyers seeking affordability. Some cities encourage density zoning to address supply shortages. Policy discussions at local and federal levels focus on how to increase affordable housing stock without disrupting neighborhood stability. Public perception of a housing crash often depends on media narratives. Headlines highlighting price drops in select cities can create fear even when national averages show modest adjustments. Experts emphasize that real estate markets move slowly compared to stock markets. Prices may decline gradually, rather than collapse suddenly. Homeowners who purchase before the boom generally retain significant equity. Even if prices soften slightly, many remain above pre-pandemic levels. This equity cushion reduces forced selling. Unlike previous housing crises where negative equity trapped millions of borrowers, the current situation shows stronger balance sheets for most homeowners. At the same time, certain vulnerable groups face higher risk. Buyers who purchased at peak prices with minimal down payments may feel pressure if local values decline. Job loss or unexpected financial hardship could increase foreclosure rates in specific pockets. Monitoring delinquency trends provides insight into underlying stability. Government policy continues to influence the market. Tax incentives for first-time buyers, infrastructure investments, and zoning reforms all shape supply and demand. Discussions about interest rate policy also affect mortgage rates indirectly. Even small adjustments in benchmark rates can shift affordability significantly. For families deciding whether to buy in 2026, the choice depends on long-term plans rather than short-term predictions. Real estate historically rewards patience. Those planning to stay in a home for many years may view modest price fluctuations as less important than securing stable housing. However, speculative buyers seeking quick profits face a more uncertain environment. Looking ahead, analysts expect continued regional variation rather than a single national outcome. Some markets may experience noticeable price corrections while others remain resilient. The phrase housing crash suggests sudden dramatic collapse, but current data in 2026 indicates more of a cooling and rebalancing process in many areas. The broader question remains, are home prices finally falling in a meaningful way? In certain cities, yes, modest declines are visible. In others, prices have plateaued after years of rapid growth. Overall affordability challenges persist. But systemic financial instability appears less severe than past crises. 4. Viewers trying to understand the 2026 housing landscape, it is important to examine local data rather than relying solely on national headlines. Employment trends, population movement, new construction levels, and mortgage rate changes all provide clues about where the market may move next. The U.S. housing market in 2026 stands at a crossroads shaped by interest rates, economic conditions, demographic shifts, and policy decisions. Whether this period becomes known as a crash or simply a correction will depend on how these factors evolve in the coming months. What is clear is that the era of easy price surges has slowed and a more cautious, balanced phase has emerged. As Americans continue searching for affordable homes in stable
investments, the housing debate will remain central to economic discussions.
Buyers, sellers, investors, and policymakers alike are watching closely to see if this is the beginning of a deeper downturn or the start of a healthier,
more sustainable market environment for the future.